Hello traders, this is Blake Morrow. You were listening to the week ahead video for March 14th, 2021. I hope everybody's having a great weekend. I want to welcome you to this week's video. We got a lot to talk about because we have a lot happening this week. But before I go into this, I have to mention that, if you guys find these videos beneficial, please give us a thumbs up. It really helps and it really makes us feel great. Give us a thumbs up, share the video. If you see us on LinkedIn, share that video there or on Twitter. We'd appreciate it, really would. Also, if you haven't tried out ForexAnalytix, it's only $1 for 10 days, no matter if you decide to use the light version at the end, just so you can access all the private webinars that we do for the ForexAnalytix community. You'll still get to try out the premium, but the premium version for 120 bucks a month, it's with the mobile app and everything else. It's fantastic, right? And you can access all the chat rooms, that's where I'm at all the time. Okay, enough about that. So what do we got going on this next week? A lot. We have the FOMC, which we'll talk about. Obviously, we have the Bank of England and the Bank of Japan all this week. But that's not all that's just happening. One of the things that's happening right now is that stimulus checks are being processed through this weekend, and you can see that that Bitcoin had made a move above 60,000. If you guys, were following my analysis or follow me on Twitter, and I did tweet this, I said, hey, be careful. Everybody's anticipating a stimulus payment coming out this weekend. There's money going to be plowed in the markets. This is I want to explain this dynamic, and you can see Bitcoin almost hit the 127% extension and is pulling back. Now, I still think it's bullish, but let me talk to you guys about a concept. And I tweeted this, and I want to talk about it because not all of you are in the chat rooms. Not all of you are, can listen in, when I'm talking about this live. So I want to talk about this concept. And I tweeted about it. When, I first started trading the most senior veteran traders would always tell you, hey, tops in when mom and pop buys. And remember, back in the 80s and 90s, mom and pop was, it's the old adage, when the taxi cab driver or the guy shining your shoes at the airport's like, hey, you heard this stock, Yahoo's going up. I just bought some Yahoo, and you're like, you're shining my shoes and you're buying Yahoo. That's mom and pop, right? You got all retail, everybody's in, and then, the market collapses. Hence, what happened in the .com bubble. The mom and pops nowadays, and they always say that's because, when the markets suck in all the retail customers at the top, everybody's like, it's going to go up forever. It's never going to come down again. I'm buying. I can't miss out. I got major FOMO. Then what happens is the market usually peaks and reverses, right? Well, today's day is a little different. Mom and pops, well, first of all, let me, before I even say that, we're in the internet age. So, the age of information, we're living it every day. You have access to anything and everything pretty much on the internet. So mom and pop's a little bit different. And when rates have been zero for so many years, the mom and pops have already been forced into the market. When you think about like your parents or your, anybody who's a baby boomer, they're kind of like, all right, I've been in the market and I have no choice because where am I going to put my money? I'm not going to put it into savings bonds, right? So I have to be in the equity markets, and that's just what I have to do. Well, because of that, there are no mom and pops because they're already in. But the people coming in that are the quote new mom and pops are really going to be all the people that are missing out, or they have the fear of missing out. I got my stimulus check. I'm on TikTok. I'm 25 years old. I saw this cute little teenage girl on TikTok saying how she made, $30,000 on a $2,000 investment buying XYZ, penny stock. shoot, I'm going to get in too. Whatever it is, I'm just making up things as I go, but you get the picture, right? Oh my gosh, cryptocurrencies, Bitcoin just hit new highs. I have to go buy some Dogecoin, right? Or I got to go buy Ethereum, or I got to go plow my money into Robinhood and start buying stocks. Think about all that money. We 1.9 trillion is going into is being stimulus that's going into the market, right? I think Deutsche Bank and maybe some other banks, we were talking about this on one of the webinars. It's like, okay, out of all the money that people get in their hands, 60% of that money is supposed to go back in the market because, a lot of people are getting money that already have jobs. It's kind of like, how many people got stimulus checks a year ago, and they're like, a friend of Steve in Athens, who is a U.S. citizen but has never lived in the United States, got a check in Greece, in Athens, Greece, a stimulus check. So, I mean, think about that. Like, this is like all the money is going out all over the place, right? That was the last stimulus check. This stimulus check, there are still people that are receiving checks that probably shouldn't. People that have jobs, what are they going to do? They're like, well, I've got a job, I've got money, so I'm going to take half of that money or all that money, I'm going to plow it into Ethereum, or I'm going to plow it into Bitcoin, or I'm going to plow it into equities, because look, I'm missing out. I mean, the stock market just continues to go up and up and up and up and up, so I'm going to put it all in. So now they are the new mom and pop. Basically, the point is that when the market sucks in everybody in, that's usually when we peak. So in this case, you have, let's just say it's $200 or $300 billion, out of the 600 billion that's being put in the market, that's going into direct payments. I don't know what it is. It's 600 billion, 500 billion, whatever. Let's say 50, 60, 70% of that money gets plowed into assets. You have another $2-3 billion or $200 or $300 billion hitting the market. Yeah, then if I'm an institution and I've been buying, ever since last year at the S&P when it's at 3,000, this is where you get the transfer of wealth. I'm a middle class guy in the United States, and I make $80,000 a year. I got a $2,400 payment because I'm married, or whatever it is. I think it's $2,400. I think it's like, or maybe it's $2,800, something like that. So I've got this money. I'm going to invest it in the markets again, and then all that money at the top, you got institutions that are selling to you, and then they're going to book profits, and you just bought the top, and you hold the hot potato, or you held the chair, and then the music stops. That's what we have to be really fearful of, and careful of. I'm not saying fearful, careful of. And that's why I was saying, watch, if you follow me via Twitter, I'm like, watch Bitcoin. It's going to surge over 50,000 or 60,000 this weekend, because you're going to get everybody buying ahead of the stimulus payments that are coming out. Stimulus payments come out, they plow in. We hit 127% extension. We diverge because we diverge. And so tomorrow morning, if Bitcoin is back below, like, let's say 58,000 or something like that, that's probably going to signal that there's some risk off coming. And what I'd be really concerned with on Bitcoin is if we get back down below like this 52,000, because this is the breakout point. If you don't recall from our analysis throughout the week, that was a 618 retracement. We hit up against that resistance and broke out. We get back below that, and then we're below that trend line and below that breakout point, and then we get a reversal. So that's what you have to be careful of. And if that happens, then you've got to be thinking that other risk assets are going to come down. Remember, Bitcoin, Ethereum, all these cryptocurrencies are the ultimate risk asset. They are. You want to take the most risk that you can right now. Forget growth, forget Netflix, I'm buying Bitcoin, I'm buying Ethereum. And guys, if you are crypto investors and you believe in cryptocurrency, that's fine. And I don't disagree with you. I don't disagree that Bitcoin is going to be a great payment transfer instrument in years and years ahead. I don't disagree with that. But the role of Bitcoin right now and other cryptocurrencies is it is the most ultimate risk-taking vehicle that you can be in at this moment. It's kind of like Netflix. It's a look. I think Netflix, and you could have heard me 10 years ago, and I would have told you the same thing. I love Netflix. I've always loved Netflix. I knew it was going to be the future of TV. I bought Netflix at the lows. I remember I bought it at like 20, and I spun out of it at 85, and I thought I was a king. And that was like what, several splits ago, and my cost average would probably be $5 now. But still, the point of that, not to tell you about me buying Netflix, but the point of that is Netflix is a great story, and it's real. Bitcoin could be that. I don't disagree with you, but the role of Netflix and the role of Bitcoin are very similar. They represent the most risk you can take when the market's going higher. But the problem is if the markets reverse, assets like Bitcoin or Netflix or whatever other company that you guys can think of that's a growth company will come under pressure too. But the good news is if you are a Bitcoin or crypto investor, these pullbacks are going to be really good. They're going to shake the trees and give you some great opportunities to get them in at better prices. Hopefully in the 30,000 to 30,000 to 15,000 range, something like this, somewhere down there. Give us an opportunity to buy it at much better prices. Shake the tree a little bit, get all the weak money out, and give us some opportunities to buy it at a cheaper price. And if you're really a crypto believer, hopefully we can get down there and you can get long. Okay, different story or I wanted to talk about that because Bitcoin's been a mover over this weekend, and I'm not saying that it's going to go down. Maybe I'm hoping it comes down a little bit, then we can get a bigger correction here. But what could happen is I could be completely wrong, and we surge towards 70,000 and continue to build out this ascending wedge, right? That could happen as well. But I want to show you guys something before I get into my expectations for this next week from the Fed. I want to talk a little bit about the Aussie dollar. Now the Aussie, and matter of fact, I'm going to pull it up on a fresh chart, one that I haven't drawn on, or I can delete. Let me delete this stuff here. Okay, so here's the Aussie. Here's the daily chart. Now what I'm going to do is I'm going to match it up to the S&P. And I'm going to put on a new price scale here. So you can see that the S&P is hitting new highs. The Aussie is not. Now, the Aussie currency, it's a commodity currency, represents growth and hope. I'm just kidding. It tends to be a bit of a leader to the rest of the markets. All right. And what we've seen is S&Ps hit new highs as people have been excited about stimulus payments and, infrastructure spending that's coming over the next year, not talking about taxes yet, all that stuff. The Aussie hit a new high, and then we failed to hit a new high. So now we have to keep an eye on the Aussie, not necessarily to be selling the Aussie right now, but any whiff that stocks, let's just say we get that, buy the rumor, sell the news on the stimulus, right? Stocks come down a little bit. And I'm not saying the stocks are going down here. I'm just saying, let's say stocks, correct a little bit, and we head down to like 3,500, 3,600. Well, that's when, you have an Aussie dollar that has failed to hit new highs, sets up a, possible head and shoulder pattern. So I want you guys to keep an eye on the Aussie if stocks come down. And I'm not saying they are going to come down, but these are the setups that we wait for. Okay, these are the setups that we wait for. This divergence in correlations is very important. We do have some important Australian news this week. We do have employment data coming out Wednesday night. It's Thursday morning if you're in Australia. So it's something we should keep an eye on. Okay. Now let's talk a little bit about the Fed really quick, because the Fed is, let me remove this. You know what? I'm gonna do this. Let me hide that, and let me flip over to the dollar. Let's talk a little bit about the dollar index. All right, as I talk about the Fed, and guys, just so you know, let me stop here for a second before I talk about the FOMC. When you're in ForexAnalytix, you can access live charts through here, okay? But the reason why I don't use this when we're talking is because, okay, and I can adjust everything here. It's because we have a team account where if I make an adjustment on this chart, and then one of my other team members makes an adjustment on this chart, they'll look very similar, and we can mark up the same charts, that type of thing. I do that because of obviously the ForexAnalytix analysis that you'll see throughout the course of the weeks and the days, and if you're using ForexAnalytix, this analysis that you're getting or that you're reading will be uploaded from not just myself but the rest of the team as well. So anyway, that's why I come over here and I just do it live for you guys. Okay, well, live on this video, not necessarily live because you're watching a recording. You get what I'm saying. Okay, so let's talk about the FOMC and let's talk about the Fed. So one of the things that we've seen as of late is we've seen this surge in yields. Okay, and it's not only the 10-year. There's the 10-year yield. Look at the 30-year breaking out and breaking higher. Okay, so the problem with this is that you're seeing this rally in yields, and right now, and remember last week actually, Powell, he had answered some questions. I think it was a Wall Street Journal interview, or it was a webinar. It wasn't a webinar. It was like a town hall or something where he was online. He was being asked questions. I think it was Wall Street Journal. But anyway, he basically said, look, yields are going up. This is showing us that the economy is strong, and we're fine with yields going higher. That means, we're not going to do any yield curve control at this point in time. So fine. And yields have continued to move higher since then. And this is really the market signaling that, higher rates should be higher, and maybe inflation expectations might start to creep up. But, will the Fed acknowledge that, inflation starting to increase? I don't know. But I will tell you this, that over the last few months, I've seen energy costs, just prices at the pump, because I buy groceries. I fill up our vehicles with gas. I've seen gas prices where I live up by 30% in the last 2-3 months. I've seen prices that in the grocery stores go up, but it's not necessarily the inflation data that the Fed's looking at. So they're fine with it. But what this might be signaling is things are improving, and as things improve, that means the Fed probably has to start making some adjustments in their forecasts of, their dot plots, which their dot plots is all the Fed governors showing when they expect the next hikes, the next hike or hikes. And so a lot of people think there might be some adjustments coming to the Fed dot plots this week. I'm not necessarily in agreement that is going to happen, but I think it could happen. And I think that's a risk for A, the markets, B, the dollar. So the dollar basically looks pretty strong. And I know you guys are like, well, what do you mean, Blake? We've been moving lower for a year from the highs. I agree with that. Problem is that if you look at the dollar index, we have this inverted head and shoulder pattern, and it's not complete. And what you've just seen this week is you've seen a rally, or the last 2 weeks, and I'm going to draw this out for you. You've seen a rally this last 2 weeks, and the dollar is building a bull flag formation. Now, technically, and let me grab this line here. You can see this line here, and I'm going to make it blue just so it's a different color, so it can contrast from what you're looking at. You'll notice that we came down to a 38% retracement. Now, when you retrace 38%, that means it's a fairly shallow retracement. That means there's a high probability that we get a continuation of the predominant trend higher, especially if we start breaking through, in this case, will be some resistance around 92. I don't necessarily think we're going to break 92 early this week. We might have to wait for the FOMC if it's going to happen on Wednesday. But what I'm looking at really going into this week is this. Okay. That where I just drew this box basically. And obviously I'm no fortune teller. Okay. I don't read palms for a living. But so I don't know if the numbers are exact, but really what I'm looking for is a break below the 38% retracement. That's going to be bearish for the dollar. A break above 92, that's going to be bullish. And we can't write off the dollar because remember, the euro dollar positioning, euro dollar currency positioning, it's still aggressively long the dollar, even though the positioning has decreased a lot via the CFTC data that came out this week. That means euros, the long euro is a lot less than it was. But remember, the euro dollar was above 120 and it was up above 122, and it was the most aggressive, short dollar position we've seen in, years and years and years. Now you're seeing that reverse. And given the fact that we're still below 120, I think opens the door for a move back down into the teens, moving back down towards, 115, 116 in the euro before we actually turn higher again. But what's going to confirm that is what happens this week with the FOMC. And so, in my opinion, or if we see some risk aversion and we actually start to see stocks come down, the dollar might actually get a little bit of a move ahead of the FOMC. You might start to see the dollar firm up even before then. That's something that we should be keeping an eye going into this next week. Now, there are other things happening this week, but I want to mention again, if you're finding this video beneficial for you going into this next week, give us a thumbs up. It makes me feel great. I feel like, wow, thanks guys. You really appreciate us putting together these videos on my Sunday morning. And I'm not with my family right now, but I'm filming this for you. So thank you. Our team appreciates it when you give us a thumbs up and when you share these videos. So thank you guys so much. I really appreciate it. All right, but there are other things that are happening this week. We do have the Bank of England. We have Philly Fed data. We have, Canadian retail sales. And by the way, the dollar Canadian closed, near its lows, near its trend lows. We actually hit new trend lows after that. Super strong Canadian jobs report. We have U.S. retail sales this week. We have the Bank of Japan, their rate decision. There's a lot of moving parts this week, and I think you have to be really, really careful. But if I can just say a couple things, watch the Aussie, especially how we trade early this week, and watch Bitcoin. Right? And I think that those will give you a pretty good clue on how we attack risk aversion and risk appetite going into this next week. So guys, gals, I know this is kind of a long video, but I appreciate each and every one of you listening in, and I appreciate your support for those of you that are ForexAnalytix subscribers. And if you haven't subscribed, make sure you try it out. It's only $1. I'll see you guys on the F.A.C.E webinar tomorrow morning. It's free, and if you don't know how to access that, there's a link in the description of this video. Have a great one. My name is Blake Morrow, and enjoy the rest of your weekend. Thanks.